Thanks everyone for joining our community call. I'm your host, Ariel, and we have a very special guest here, Jamie from the Perpetual Protocol. Jamie, do you want to quickly introduce yourself?
Yeah, sure. So, my name's Jamie. I work with Perpetual Protocol. I've been working with them since January this year. Always been involved in content in one way or another in the crypto industry for the past 4 or 5 years. And just really into like the trading side, financial side of things. Yeah, that's just a quick overview.
Awesome. I'm glad you could join us today.
Yep,
All
pleased
right,
to be
so
here.
let's go to, yeah, same here. So let's go through the agenda for today. First, I'm gonna quickly explain what is the Perpetual Protocol, and I'll be providing also Jamie some room so he can explain and complement what I'm saying. Then we can quickly go through the PERP tokenomics. I'm also gonna discuss some recent tokenomics updates that they launched, which are pretty interesting. And then our final slide will be about value creation and value capture, which is pretty much a summary of what we'll discuss in the previous topics. And then we will save some time in the end for a Q&A. So if you have any questions while me or Jamie are presenting, feel free to send them on the chat, but I would ask you that to hold off for opening your mic until we reach the Q&A section, just to keep this meeting organized. All right, so let's get going. So what is Perpetual? Perpetual is a decentralized exchange, meaning that their users have self-custody over their assets, in contrast to centralized exchanges, where the exchange is actually holding your tokens for you. And the main products that they offer are perpetual futures and leverage. So I included the image of the Chicago Board of Trade here, even though it has nothing to do with crypto, because the Chicago Board of Trade was the first place where people could trade future contracts. And a brief, very brief comment on the history of futures. They were developed to help mainly agriculturers protect from price fluctuations. So they, let's say you're planting wheat and the price is volatile. You have no certainty of what the price will be when you're actually able to sell your wheat. So you can use futures as a way to guarantee a stable income, and that was the first use case for futures. But they are also used for speculation. So this first use case would be hedging, and the second one speculation. And yeah, I'd be happy to provide some details if you guys are not familiar with futures. And then futures in the traditional markets, they are time bound, meaning that they have an expiration date. And the time component is important because whenever the future contract is reaching the expiration date, it tends to converge with the spot price, which is the price of the actual asset. But in the case of perpetual futures, they are perpetual because they don't have this expiration date, and they are exclusive to crypto markets. There are no perpetual futures in TradFi. And so to make sure that the future price is convergent to the spot price, what these protocols like Perpetual will do is that they will have a funding rate, which is this image right here, which I took from the Perpetual console. And what the funding rate does is it incentivizes traders to take on the least popular side on the market. So for example, right here, we're looking the 1 hour rate for the Bitcoin future contracts in perpetual. So whenever that goes below zero, it means that the future price is below the spot price. So whoever is taking a short position is paying for people that are taking a long position. And whenever the funding rate is above 0, then it's the opposite. So shorts are paying longs. And that, by through this incentive, you are able to incentivize the convergence between the future price and the spot price. And the second product is leverage. I think leverage is more straightforward to understand, but I also included an image that I thought was good. So leverage is pretty much you add some collateral or some money to be simpler in the platform. So let's say if you had a 500 to 1 leverage ratio, you could add $500 and trade into $250,000. So yeah, you can trade more than you actually added. And for perpetual, they allow you to trade up to 10x leverage. So if I add $1 in the exchange, I can trade up to $10, for example. And the third component, which is I think really interesting from Perpetual, is their builder-ready composability. So Perpetual allows other protocols or projects to build with their tools. Jamie, do you want to explain a bit more about the composability? Because I think that's the trickiest one to understand, at least for me.
Right, yeah. So the best way to think about it is like Perpetual Protocol is trying to build like a DeFi Lego for perpetuals, right? So that other projects can build on top of this. So, we're not just offering like people a venue to trade perpetual futures, but also because the code is like open sourced and because we're built on the optimism layer 2, that means we have this great feature of composability, which basically means that other projects can come in and build directly on top of our product, directly on top of our protocol. So one good example is Galleon and Index Coop. So these two projects create structured products, and basically the way they use Perpetual is to create like a basis trading product. So what it's doing basically is extracting the funding rate with a delta neutral position. So basically, they're not taking a direction in the market. So it doesn't matter whether the market goes up or down. So basically, what they're doing is they're providing their users with like a small, low risk but kind of stable yield based on based on the funding rate. So what they're doing basically is going short or long on the asset based on the funding rate, and then in the spot market doing the opposite. So yeah, they're basically just extracting the funding rate for their users and just providing like a low yield but kind of stable yield at the same time. So that's just one example, but there's countless other examples. So there's a metaverse called Atlantis World, and they've built PERP directly into the application as well. So you can go into the metaverse and enter the building, enter our building, and then take trades inside the metaverse, basically. So yeah, so composability is basically the best way to think about it is like that it's a building block of DeFi, and for Perpetual Protocol, the building block is perpetual futures, and you can build like countless things on top. So it could be like structured products, could be like data analytics platforms, could be a wide range of things. But yeah, that's what we really focus on is composability, because what we're trying to achieve with that is that basically we're building this ecosystem where PERP is used under the hood as the base layer. So instead of just like trying to attract users to our exchange, we're also building this ecosystem. And once this ecosystem, as it grows more and more, we're bringing more users into PERP, and they don't even know they're using PERP. So if they're using one of these structured products, for example, they might not even be aware that they're actually using PERP like that as the base layer. So that's really the aim of that, is just to build like a vibrant ecosystem of different projects who can build directly on top of us because we're open source and composable. And yeah, that's basically the vision.
Yeah, that's pretty cool. So just to try and summarize a little bit, I think one use case is like this structured products thing, where you would, I think, but at least as I understand it, you can design a smart contract or something of the kind to trade on perpetual, and you just offer the product of those trades to customers, so they are not even seeing perpetual on the back end. Or you could just integrate the exchange in the metaverse, as you said. You think that's a good way to summarize?
Yeah, yeah, there's loads of examples I could go through, but yeah, those are the two that come to mind for me. Is like structured products, and then just like alternative front ends, and yeah, just different ways of accessing the protocol. You know, but yeah, but the main focus for us is like structured product vaults as well, because that brings in retail, brings in other investors. So yeah, that's kind of like the main focus.
Great. All right, so moving on here, let's talk a bit about PERP-Tokenomics. So I think the first thing to note is that Perpetual's token, which is called PERP, it's a governance token, so you're not actually using the PERP token on the exchange. To use the exchange, you can deposit, I think, 4 different tokens as collateral. You can deposit
Yep.
USDC, FRAX, Ethereum, or OP. Is that right?
Yep, that's correct. Yeah, that's our multi-collateral feature, and those are currently the supported assets.
Awesome. So yeah, just to exemplify a little bit, let's use USDC as an example. So a user could deposit USDC on the exchange. Then since they offer leverage trading, they have this smart contract called the clearinghouse. It automatically mints 10 times the amount you deposited in virtual USDC tokens if you deposit USDC. But that's up to the user to decide whether they're going to use it or not, but it just makes it available. And then all the trades in the protocol happen using this virtual token system. So let's say I want to long Bitcoin, then I would trade my virtual USDC tokens for virtual Bitcoin. And whenever I want to close my position, then I sell my virtual Bitcoin and can convert the virtual USDC into USDC again. So in the end, the trades are settled in USDC, and your profit or loss will be also denominated in this token. And the clearinghouse also manages the liquidity provision in the platform. So it's pretty much the same thing that I just described. If an LP is providing liquidity, they'll deposit USDC, and then that's gonna be turned into virtual tokens, and they can deposit into the pool of their choice. Could be a Bitcoin pool, or I don't know, a PERP pool, you name it. But this exchange for virtual tokens is always happening and is always managed by the clearinghouse smart contract. And so, as I had mentioned, they offer futures, leverage trading. I can talk a little bit more about the token pools in a later slide, just to focus the attention on the overall tokenomics. And so, okay, let's go to the PERP token. So as you can see here in the trading and liquidity provision, the PERP token is not involved. The PERP token comes up when we're talking about the perpetual DAO. So in the Genesis supply, the perpetual protocol allocated about 55% of the tokens issued, which were 150 million, to the perpetual DAO's treasury. And to govern over the treasury, then you need the PERP token. So as I mentioned in the start, they recently introduced some updates to their tokenomics, which are mainly the voting escrow PERP or vePERP, which is similar to the circle model, where you lock your tokens and you get some tokens back, and then you would need that to vote on governance proposals. But before that, I think you just needed to stake the tokens, then you would be eligible to vote on governance proposals and actually decide how these funds will be allocated. So I'll provide some more details on vePERP and also let Jamie comment on it in the next slide, just to make sure that we can get through everything here. And besides, I think the other cool thing about the vePERP introduction is that they are starting to distribute rewards to users. So by locking tokens, you become eligible to referral rewards, and you also earn a portion of the trading fees from the platform. And I guess maybe the other two things to note are the liquidity mining rewards. So Perpetual incentivizes LPs to provide liquidity to certain pools. And I think the rewards depend a bit on the pool. Like if they need more liquidity to that one, you probably earn more rewards. But LPs become eligible to earn either PERP or OP tokens through this mechanism. And I guess the last thing to note here is the insurance fund. So currently 20% of the trading fees generated in the protocol go to the insurance fund, which has the main goal of maintaining the protocol's solvency. So since they have products like leverage, it's important to make sure that, in case a trader is not able to cover his margin, that the protocol has some kind of funds to cover that and avoid, systemic risk in the end. So that's the main goal of the insurance fund. So moving to the next slide, and here I'll finally provide some more details on the voting escrow. So as I mentioned, actually let's go through the mechanism first. So I think, at least as I understand it, the main reason that you would want a voting escrow in your protocol is to avoid people just buying tokens in the market and being able to shift voting governance votes in their direction, because there's not, like, you're not necessarily incentivizing your long-term holders if you don't have a voting escrow, because you just need to have the tokens at the time you're voting. Whereas if you have a voting escrow, as Perpetual is still implementing, I think they completed the initial phase, but they have a lot of plans to complement that. Then you provide weights also based on the amount of time that these tokens will be locked. So I think this table in the left corner is pretty helpful to illustrate what I'm saying. So in here you have two columns. In the first, someone is locking 10,000 for 52 weeks. And in the second column, they're locking 10,000 for 26 weeks. And so, as you can see that, like in the second row here, the first week of your unweighted vePERP. So that's how much they have. It's like a soft amount, let's say, because even though they provided 10,000, since the weights also take into account how much weeks are left, then in the unweighted vePERP, the person that locked for 52 weeks will have the double as the person that locked for 26 weeks, and that means they would also have double the voting power, and they also earn double the rewards as versus the 26 weeks person. So I think this table is helpful to understand that, if you're a long-term believer in the project and you lock it for the maximum number of weeks, which is 52, then you get extra rewards and extra voting power. And that, I think the goal here is to hopefully let the long-term believers in the project to determine where the governance voting is going to go. And but to do that, you provide some incentives through the voting escrow. And in this graph, in the right corner, just illustrates how the unweighted vePERP decreases over time as your lockup period starts to expire. So if I locked for 52 weeks, then the unweighted vePERP is decreasing until reaching 0. So when it reaches 0, it means that my tokens will be unlocked. Then I have the exact amount that I locked plus my rewards, which I would have to relock on the protocol to get extra voting power for these rewards. Jamie, do you want to comment a bit on your ideas in introducing the voting escrow and how it's been going so far?
Yeah, sure. So I think I'll touch on the governance aspects first, because that's kind of like the easiest to understand, right? So basically, what the reason for introducing the V token model was that, with normal governance tokens, the old governance kind of tokenomics, so they're actually like susceptible to like attacks, right? Because, someone with a large amount of funds can just like get a loan or buy a bunch of tokens, and like all the course of the protocol by voting and governance, like their incentives may not necessarily be aligned with that of the protocol. So with the lock-in and the V token and VPERP model, it's like people who are really like really believe in the protocol, and they contribute the most, or they're active, they actually have more of a say in governance, because when you lock your PERP, we use a weighted model for the governance votes. So that basically means if you locked 10,000 PERP, you'd receive 40,000 PERP in voting power. So it actually boosts your governance voting power. Whereas for the rewards, like for like lazy river rewards and referral rewards and that kind of stuff, it's actually based on the unweighted balance, as that table shows. So if you lock it for the maximum amount of time, you get the same amount of VPERP. But if you lock for, like, say, 26 weeks, which is half the maximum time, you only get half the amount of the perp that you lock. But then obviously once the lock time is done, you receive your perp back the same amount. But it's just that the VPERP balance declines over time. So that encourages people to lock for longer and lock more tokens. So yeah, the other thing to mention is the reward programs. So basically, the VPERP token is linked in with certain reward programs. So the first one was the referral program. So the more VPERP you own, the higher the share of the referred volume. Basically, you get like a rebate on all the referred volume done by all referral partners. So basically, it doesn't matter how much volume you refer. If you lock more and more perp and have a higher V perp balance, you'll get a higher share of that referred volume. And then secondly is the lazy river, which is our staking model. It's like a improved version of our staking model, which is on optimism. So basically, what happens there is that we're incentivizing people to lock up into V perp by offering weekly rewards in perp tokens. So what this does, it kind of sets the stage for our USDC fee distribution. So eventually we'll be sharing 10% of the trading fees directly to VPERP holders. But until that feature is ready, we're actually going to share the same amount, so 10% of the trading fees every week. But instead of in USDC, we're actually sharing it now in liquid perp tokens. So yeah, if you lock into VPERP every week, you can claim some rewards, and yeah, you can do whatever you want with those perp tokens. You can either lock them or sell them, or hold them. But yeah, the idea is basically to incentivize people to start locking up, and you're taking that chunk, like a big chunk out of the supply. It's not circulating, so it's not something you can exit. You can't transfer, you can't sell it. So what this does basically is, it's building an ecosystem. Like if you see Curve is like the project that introduced the V tokenomics and made it popular, and they've built like a really vibrant ecosystem based on this tokenomic model. But also at the same time, it's supporting the growth of the protocol as well, because we're locking up the supply, and as demand is increasing, that should have a positive influence on the price over time. And then yeah, the final thing I'll just mention is that yeah, the VPERP, it's like the move to the V tokenomics and VPERP is like a gradual process. So as I've mentioned, we've already implemented it for for the referral program, and we're getting ready to launch the USDC fee sharing in a few months. Also, we'll also integrate the VPERP model into liquidity mining as well, because at the moment it's not really linked up in that part of the model, but that's another direction that we're going to head down as well. So yeah, that's all I want to say about that part.
Awesome. Yeah, thanks for this summary. I think it was great. So yeah, just to summarize a little bit everything that we discussed today, I think the value creation of the Perpetual protocol is, they're offering very robust financial products such as leverage and futures, and provide deep liquidity for traders. They also allow market making. There's the composability component that we discussed. And as Jamie mentioned, they are deployed on optimism, so that helps to optimize the gas fees that the protocol is paying. So they're paying the very much lower gas fees because they deploy it on layer 2. And they're also using Uniswap v3 liquidity pools. So they offer composability, and Perpetual themselves are composing on top of another DeFi money legal, which is the Uniswap v3 liquidity pool. And I won't get into the details of the explanation because I think it's a bit complex. But if anyone has this question, then we can discuss in the Q&A section, which is the next slide. And for value capture, the main mechanism to capture value is the trading fees, which is a flat fee of 0.1%. These fees accrue to the traders and to the liquidity providers. And I think one interesting aspect of the value capture will be the USDC yield switch, when they will distribute this part of the trading fees to stakeholders in USDC. So that greatly increases yield quality. All right, so I'm gonna get into the Q&A section. I see that there are 2 questions in the chat already. Mason, do you feel your question was answered in Jamie's explanation, or would you like to come up and ask again?
Yeah, I guess partially right. I mean, but so currently, one thing that wasn't clear to me. So the USDC fee switch is that obviously that's not in place yet. But what are fees paid in currently if it's not in USDC, or are fees not paid currently?
Yeah, I can answer that. So at the moment, the trading fees, 80% go to the liquidity providers, and then 20% goes to the insurance fund. But yeah, as I mentioned, the Lazy River initiative is like setting the stage for the USD fee distribution. So it's not actually taken out of the fees, but we're just paying out of like emissions of PERP. So basically 10% of the trading fees are paid out in liquid PERP tokens to vePERP or locked PERP holders. But in the future, once the USDC fee switch is activated, then LPs will continue to get 80% of the fees. 10% will go to the Treasury DAO, and the final 10% will go to vePERP or locked PERP holders. So in April, we had a governance vote to decide the parameters of like how much goes to the Treasury DAO and how much goes to the PERP holders. So yeah, in the future that could change for a governance vote. So the PERP holders might want to vote for like a higher percentage. But yeah, that would have to be done for a governance vote. But yeah, that's the basic overview. Yeah, I hope that answers your question.
Cool. Yeah, and like I don't know if I missed it or not, but like so I guess the PERP issuance currently, does that as in if you sort of have vePERP, does that have any influence on the issuance? Just obviously comparing it to like Curve's model where you look up Curve and then you can sort of have a say on issuance.
Right. Yeah. That's so I think that would be related to like the liquidity mining aspect. So that part is not introduced yet. So I think the plan is to once we incorporate liquidity mining into like the vePERP model, it would be like you get to decide similar to Curve, like where the most of the rewards, which markets they go to. So if you provide liquidity to the ETH market, for example, you'd vote for ETH, and then you can like direct the emissions and rewards that way.
I see. Cool. And like currently, it's just a standard liquidity mining program, right? Like time-based emissions type thing, right?
Yeah. It depends on how long your liquidity is active for at the moment, and you obviously earn the fees, but you also earn some rewards in OP tokens and PERP tokens. But I think the rewards will be like, I think they'll be boosted actually based on like the vePERP you hold. So I don't think it'll be exactly like the Curve emission model. I think it's still under like it's still in the works. So the details are not finalized yet, but we will be incorporating like the vePERP and linking it to liquidity mining as well, and that kind of with the fee switch as well, that will like complete the whole transition.
Nice. Awesome, thanks.
No problem. Thanks for your question.
All right, we had another question on the chat by Richa, but it seems that she left. So does anyone want to ask another question? Then I could just, respond to that first.
Yeah. Hey, Jamie. Could you? So I'm somewhat familiar with leverage trading, and I know Ariel has already kind of outlined what the insurance fund is for. But could you explain it with an example? Because I honestly don't really understand how there can be a situation where you need the insurance fund. I guess it's something to do with high volatility and like liquidations can happen, but then the collateral is already gone. Like I don't really understand, because technically you shouldn't be able to bet more than you have collateral for, right?
Right. Yeah. So I think the best way to think about it is kind of like a backstop, right? So you need to pay out people if they're in profit, right? So where does the money come from, right? It should come from the losses from other traders, right, or the losses of the liquidity providers. But if there's a situation where the profits can't get paid out because there's not enough liquidity, or there's not enough variety in the number of traders, that they're not taking different directions, or if everyone's long, for example, then the insurance fund is there just to make sure that everyone can be paid out, their profits can be paid out when they close their positions. So yeah, basically it's like a backup mechanism just in case like the funds in the clearinghouse are not enough to pay out everyone. Yeah, it can get quite technical and detailed because there's other mechanisms at play as well, because you also have this kind of like auto deleveraging as well. If there's not enough money to pay out the profits, then people's their leverage positions will have to get reduced like by a certain amount, like, and then you'd have to pay out a partial profit. But yeah, the insurance fund is just like the worst case scenario. Yeah, if you think about like the Mango hack, or not hack really, but it was an exploit. Like the insurance fund there, I'm not sure if they had an insurance fund, but yeah, it's basically for like situations like that, really like edge cases, or like really, worst case scenarios. It's just there to like provide like a buffer, and make sure everything runs smoothly if there's like a big event, or something bad happens, or yeah, that's basically the way to think about it.
Okay, cool. Yeah, that's helpful. Thank you. I appreciate that.
Yeah, and you can also check out our docs as well. Like we explain all of these things in the docs. So I think there's a page dedicated to the insurance fund. Just basically explain what it's there for and how it works.
All right. So, yeah, I think we can end this section. I want to thank everyone for attending to this presentation, and again, thank Jamie for not attending, but presenting with me. I think it was pretty helpful to have you by my side today, Jamie, and just provide a more internal view of all the affairs that we're presenting. And I think, it was some time well spent, at least for me.
Okay, great. Yeah, thanks for inviting me. It was great being here, talking to you guys. Yeah, I look forward to the next community talk. Join the Discord now, so yeah, probably see me be active in the Discord now.
Yeah, that's great. So yeah, thanks everyone. Hope you had a good time.
Yeah, super interesting. Thank you so much for joining, Jamie. Thank you, Ariel, for the presentation.